Can I get your attention, please? Ladies and gentlemen, I believe that in every one of our lives, we can find someone who helped us become more than we thought we could be. When he turned 80, at his birthday party in London, I was asked to give a speech. And characteristically, on a birthday party, people talk about the gifts that they want to give the person celebrating the birthday. But on that night, I decided to turn things inside out and celebrate the gift that George Soros gives us to all of us. And speaking very frankly, through his example, I have learned more about the value of discomfort than from any other individual I've ever met. And I don't mean by that entirely that he's made me uncomfortable at times, though he has helped propel me to do things that I never envisioned trying to achieve. More, I think about his example. This gentleman, who is more than 80 years old, sometimes wears me out with the intensity and the drive and the sense of purpose and the sense of urgency that he exhibits in his business life when we were once partners, but now in his philanthropic life. I don't know how to share with you last summer the powerful experience of seeing George concerned about the disintegration of Europe. Tomiko, I know you remember when we went out to dinner in Brussels and we worked to help George feel that there was nothing more he could do, that he had given so much of himself and the love in his heart to the continent and the society where he grew up and where he saw the capacity for pain and evil. And when George and I began to talk about INET, what he really impressed upon me at the time of the bailouts and the TARP legislation and the distrust that was growing in the United States was that the stakes were not some simplistic or technocratic cost-benefit analysis, but it's whether or not our society could be resilient in the face of a challenge to a feeling of trust and order in the continuation of that society. As Harold James, one of the scholars who works closely with INET, has often talked about, the 1931 banking crisis in Austria and Germany created a pressure on the fabric of trust, on the nerve center of society that led to, as we all know, some very, very unfortunate experiences and results showing a dark side of humankind. And so, for me, as I try to think of examples in my life and I try to propel myself to make a contribution, I will always remember last summer. I'll always remember the deep, emotional, heartfelt energy that George gave to Europe and that he continues to give in all of his endeavors right now. Ladies and gentlemen, George Soros.
Well, after this introduction, it's my privilege to introduce another member of our Mutual Admiration Society. As you have heard from Rob Johnson at lunchtime, the INET is now entering a new and constructive phase. The initial task was to show that the prevailing paradigm of efficient markets and rational choice is fundamentally flawed. I think enough progress has been made in accomplishing this task to take on the next one, which is to produce new insights and new theories. As Rob Johnson explained, the primary objective of INET is to reform economics as it is taught in universities. What perhaps he didn't emphasize sufficiently, that economic policies also need to be reformed. Now, we could not have found a better person to lead that effort than our next speaker, Lord Adair Turner. He was the chairman of the Financial Services Authority and of the United Kingdom, and he also chaired the European Financial Stability Institute. He was a candidate to be the next governor of the Bank of England, but fortunately for us, and I believe also for the world, he was not selected. And this is fortunate for the world because it frees him up to speak his mind. And he has some very original ideas that we will all benefit from. I think that Turner is the most brilliant, most penetrating mind preoccupied with the unresolved questions of financial stability and financial regulation. I know this for a fact because he was the first financial regulator who took an active interest in my theory of reflexivity. What more convincing evidence could I possibly ask for? Now, I'm really very pleased and very proud that he agreed to join INET as Senior Research Fellow. If the recent economic crisis is going to produce some profound new insights, such as John Maynard Keynes did in the 1930s, he is the one. Truth be told, I had some aspirations myself, but I'm somewhat old, and I don't have half his qualifications. So I am really pleased to hand on the baton to him. So I'm pleased to present Adair Turner.
Thank you, George. Good evening, ladies and gentlemen. Well, thank you, George, very much. I'm not quite sure what to do after that introduction. First of all, I've got to produce a new general theory in about the next hour and a half. But I am very glad to be becoming a senior fellow of INET. It's an arrangement we've made which is going to give me the freedom both to help INET in all of its activities, which I believe are incredibly valuable. I think that before the crisis, there was a real failure of academic economics to address in an effective fashion the problems which were facing the world, and that the rebuilding of economics with new thinking is a vitally important task. So I'm very glad to have been given by INET the support and the freedom both to support their activities and to pursue areas of personal research where I hope to be looking at the integration between some issues to do with the nature of finance, the nature of technology, where jobs are coming from, and inequality. It's also a great pleasure to be speaking here at this fourth plenary. We are 4 years old. We were told earlier today by Victor Fung that we're a bit older than the Fung Institute. They're still in the terrible twos, where, as we all know who've had children, toddlers have tantrums at 2 years old. But hopefully you'll move beyond whatever tantrums you've got. We are beginning to head into sort of preschool age, and hopefully, therefore, in a position to make major contributions. So I am very pleased to be speaking here at this fourth plenary, as I have on the 3 previous occasions. But I do have 3 problems or concerns about my speech this evening, to which I have no solution whatsoever. First, I'm a bit concerned to be speaking over dinner. As those of you who've been at the last 3 plenaries at Cambridge, at Bretton Woods and Berlin know, I've done for 3 occasions in the past this dinner gig. And on each of those gigs, I've been asked to talk on a general subject of the whole of what was going on at the conference. And I said to Rob earlier this year, well, I've done 3 of those, but I'd like to do something different this year, because I'd really like the opportunity of presenting a sustained argument, and a serious argument, an argument with some facts and some exhibits and slides and theory and that sort of stuff. I don't want to just be the joke man, just not the light entertainment. And Rob said, okay, that's fine. You'll be on the agenda to do that. But what he didn't tell me is that I would still be talking over dinner. So for those of you who, after the cocktail, thought that at the end of a long day, another Rob Johnson organized a intellectual feast in which you start working and keep working and keep working, that now was the time to relax and take it easy. Well, I'm sorry. You're going to have to look at some exhibits. You're going to have to do some work. And, you just have to stick it. So my second problem or concern is that I'm going to talk about financial stability and monetary economics. And financial stability and monetary economics is the sort of intellectual ghetto that I've had to inhabit for the last 4.5 years at the FSA in response to the financial crisis. And I hope at INET conference next year, wherever it is, to be able to escape from that ghetto and to perhaps talk on some of the wider issues which we've discussed during the day. I mean, during the day, you've discussed the whole future of China. You've just a fantastic session on the nature of innovation and where technological innovation comes from, and then a fascinating session also on mimetic desire, the fundamental nature of what we are as human beings. So I'm rather sad to bring us back to this technical issue of finance and monetary, because when you think about it, the area of macroeconomics and financial stability is not actually addressing the fundamental issues of fundamental constraints or difficulties in the world, like resource allocation, or fundamental opportunities, like innovation and technology. It's actually basically dealing with the avoidance of negatives. What fundamentally macroeconomics is about is making sure that we don't screw up. It's making sure that we can somehow have enough stability in the development of nominal GDP and of the price level that there is the opportunity for the really important things in economics, which are innovation and human capital and creativity, to express themselves. So I'm at the negative end of today's agenda. But that negative aspect of monetary economics, financial stability, is still very important, because although monetary economics and financial stability issues is really about the avoidance of self-inflicted wounds, when we have those self-inflicted wounds, they're terrible. The whole of the 1930s Great Depression was a self-inflicted wound. As Roosevelt said in his inauguration speech, America was not challenged by some sudden loss of productive capacity. Its factories were no less productive, its workers no less skilled, and yet it suffered a terrible, terrible depression. And on a fortunately minor scale, what happened in 2007 and 2008 was not driven by any fundamental conflict between social classes about the distribution of income, which is always a difficult issue. It wasn't driven by an inability to continue the process of innovation. It was a self-generated failure within the financial system. It was totally self-inflicted wound. So although I'm afraid I am concentrating this evening on the negative issues rather than the fundamental issues or the positive opportunities of economics, again, I'm not apologetic. I think it is an important, though a limited agenda. My third problem is something Rob said at lunchtime in his welcoming remarks. He said, well, we call ourselves the Institute for New Economic Thinking. And he said that places some burden and responsibility with us after a time to come up with some new economic thoughts. And if I could have my first slide could just come up here, the problem that I have in that respect is that I have entitled this evening's presentation, Private Debt and Fiat Money, Lessons from the Crisis and from some Old Economics Texts. So I feel somewhat worried. Why am I going back to old economics texts? Well, it's because despite the need for us to think about new thinking, there's still a lot of wisdom in old economics texts. And also, I think I can defend myself that going back to old economics texts is right from the beginning, established as a key INET activity. Those of you who were at King's College, Cambridge, 3 years ago in 2010 at our first plenary will remember that the very first session, which was compared excellently by Robert Skidelsky, took us back to the relative merits of Keynes and Hayek. And many of us noted then the somewhat irony that the Institute for New Economic Thinking had begun by thinking about a set of debates which occurred 70 years ago. But there is still huge wisdom in old economics texts, and I'm going to begin today by referring to some old economics texts, and perhaps surprising ones, because I'm not going to talk about my great intellectual hero, Keynes, but to some of the founding fathers, actually, of the Chicago School of Economics, people who supported a very strong, clear, laissez-faire economics, perhaps more laissez-faire in some respects than I would agree with, but who in particular issues to finance were not laissez-faire at all. And I'm talking about Henry Simons, I'm talking about early Milton Friedman in 1948, and I'm talking about Irving Fisher. And those economists came up with two really quite radical propositions in their writings in the 30s and 40s. The first was that finance was subject to such potential instability, and that in particular banking was subject to such potential instability, that not only should we regulate banks tightly, but that we should regulate banks out of existence. They didn't believe that fractional reserve banks should exist. They believed that we had made a major elementary mistake in allowing banks to create private money and credit, that the creation of money was an essential monopoly function of the state, and therefore they argued for 100% reserve banks in which the monetary base is the money supply. So that was radical idea number one. Radical idea number two, which is clearly set out in Milton Friedman's 1948 article, is that contrary to the idea that money finance of fiscal deficits should be the ultimate taboo, written into the constitution of the ECB, the worst possible thing you could do, the thing that is bound to produce inflation, that actually we ought, not sometimes, but always, to finance 100% of fiscal deficits with newly created money. That is precisely what Milton Friedman argued in 1948. So here you have these Chicago school, laissez-faire economists, believers in a free market, believing in 100% reserve banking and 100% money financing of public deficits. And I would like to use that set of radical thoughts, that provocation, to simply explore why did they think that, and what implications should we draw from that, even if we don't go all the way in that radical direction. Because often when you have radical ideas in economic theory and economic thought, it's valuable, even if you don't agree completely with their conclusions, to understand what the argument is and perhaps to understand that they are right up to a degree. So let me begin with suggesting, in relation to this issue of the role of finance, banking, and why they ended up in such a radical position on what banks should be and how we should regulate them, with suggesting 4 pre-crisis, our latest crisis, delusions. 4 failures, either of economics or of policy. We assumed we could ignore the details of the financial system. That's a statement from Olivier Blanchard, the head of the chief economist at the IMF. We largely created macroeconomic models from which the details of the financial system and the banking system were almost entirely absent. We assumed that financial activity and financial innovation were axiomatically beneficial because we know that market completion is good, so yet more market completion is even better. We believe, therefore, that financial deepening was limitlessly beneficial because, again, why wouldn't it be? If you believe in market completion and you believe in laissez-faire economics, everything that the free market does must be beneficial and must be taking us close to a sort of nirvana of Arrow de Breu Pareto equilibrium. And finally, though I think this is less a failure of a rigorous economics, but a failure of much policy making, we assumed that credit growth was essential to nominal demand growth and that we couldn't drive an economy of growth without accepting, or in some cases deliberately stimulating, a relentless increase in the credit to GDP ratio. Now, those propositions were, I believe, incredibly harmful propositions, and they were propositions which were rejected entirely by the mid-20th century economists to which I have referred. And I think it's useful to think through why they were so completely against those assumptions. First, they believed, broadly speaking, that finance was different, and I think that is a key insight, that the propositions in favor of free markets, which are pretty good in relation to how to run the restaurant business, break down for a whole set of reasons which have been explored by many people in the INET community in relation to finance. But even more important, those mid-20th century writers believed that banking was different and that debt was different. And they believed that we had to understand 3 potential drivers, or at least they focused on 2, and then the third one is added by Minsky, 3 potential drivers of financial instability, which I want to run very quickly through. The first, debt contracts create specific risks. Debt is different from equity, and the more debt contracts we have in our economies, the more we have potential for instability. Secondly, unregulated bank credit and private money creation is inherently subject to instability, and unless tightly regulated, will run out of control. And thirdly, and this is where Minsky comes in, because this is not really in the writings of Fisher or Simons, lending secured against real estate or against any asset which can rise in value as you extend more credit is deeply pro-cyclical. From which it follows that real economy leverage credit and credit creation dynamics and credit asset price cycles are crucial macroeconomic variables and phenomena which we ignored and overtly stated that we could ignore in the pre-crisis period. Let me run very quickly through the arguments in favor of those 3 propositions. First of all, debt contracts in general. I think one can identify 3 reasons why debt contracts are different from equity contracts. The first is the tendency for myopia, or for what André Schleifer has called local thinking. When you hold an equity contract, you see the value of that going up and down every day. You know that you hold something which has risk in it. The difficulty with a debt contract is that if you think about the frequency distribution of returns, it has a significant probability that you'll get all your money back, and then a tail of the probability where you lose. But in the good times, that tail is not observed. So as Schleifer has said, you're subject to local thinking, a strong tendency in the good times for people to assume that inherently risky debt contracts are riskless, and therefore to be willing to extend those in excessive quantities. And Schleifer has made the point that in the pre-crisis period, there were many debt securities that, in his phrase, owed their very existence to neglected risk. And there was a totality of debt contracts across the economy which was larger than could possibly be supported by the objective risks which existed at the level of the pre-debt servicing operating risks of the economy. And that creates the possibility of multiple equilibria. And if you want an example of multiple equilibria, think about Greek debt. 2006, Greek debt is trading at about 30 basis points higher than German bonds. And people are queuing up to lend the Greek government debt because they have fallen into that local thinking where they are no longer doing the objective analysis of the underlying risk. So debt in itself is subject to local thinking, volatility of credit assessment, first unreasonably optimistic and then swinging to extreme, and the denial of the willingness to extend new credit, and multiple equilibria. Secondly, when debt goes wrong, it goes wrong in a non-smooth, crunchy fashion. When you hold a debt equity instrument and you lose money gradually. You know that you could lose money, and the system can absorb that. Debt contracts go through processes of default. And default is a denial of a complete market system. Ben Bernanke, in his essay on non-monetary features of the Great Depression, of the banking crisis, has this great phrase that in a complete markets world, bankruptcy would never be observed. There would be a smooth adjustment of the value of the debt contract as you approached bankruptcy. But in fact, in the real world, we see bankruptcy, we see default, we see those non-smooth adjustment processes. And then the third difference is the need for continual rollover. Because debt contracts have a specific term, they continually come to an end. The economy needs them to be continually rolled over. Victor Fung earlier today talked about what happened to trade in 2008 when trade finance got cut back, a sudden shock to the real economy. There's a real distinction here between equity and debt. You could imagine an economy in which new equity issues were zero for 5 years and in which it still functioned. There would still be a process because the equity investment that you've given in the first place is perpetual. But because debt has to be continually recycled because it is not perpetual, the process of new credit provision is fundamental to the macroeconomy, and when it gets interrupted, severe bad things happen. So first, debt contracts are different. They create specific risk. Secondly, banks are different. And I think this is a crucial insight that we often miss, but which Fisher and Simons and Friedman really focused on. It is often said in general textbooks or discussions, what do banks do? And you'll often hear this description, well, they take deposits and they intermediate it to investment. This is a lousy description of what banks do. The idea that banks intermediate a pre-existing set of liquid asset savings is wrong. Banks simultaneously create new private credit and new money. They do that because they have a maturity transformation function, and the fact that they do it is a fundamental macroeconomic variable of vital importance to the dynamics of nominal demand growth. And it is crucial that we understand, as Simons and Fisher and Friedman did, that difference. And then thirdly, lending secured against real assets. Lending secured against real assets which can rise in value is inherently subject to the sort of cycles which Hyman Minsky described, in which increased credit extended increases asset prices, produces expectations of future asset price increases, produces increased borrower demand for credit, but simultaneously produces low credit losses, high bank profits, confidence reinforced, increased bank capital bases, favorable assessments of credit risks, and an increased lender supply of a credit. And that process is inherent to why credit is provided in such a strongly pro-cyclical fashion, over-provided in the upswing, and then under-provided in the downswing, as all those elements go into a reverse. Now, the implication of all that, debt is different, banks are different, lending against secured assets is different, is that the size of the banking sector, the amount of real economy leverage, and the amount of money being put against real assets and asset price cycles, these are fundamentally important economic variables, but variables which we largely ignored in the pre-crisis period. And we sat for many years watching, or rather not watching, but we should have been watching, dramatic changes in the size of these variables across our economy without realizing what a large effect they must be having on the degree of financial instability. So that, for instance, if you look at, this is headed the growth of the financial sector, it ought to be the growth of the real economy and financial sector in leverage. If you look at the UK on the top and the US at the bottom, you will see over the last 20 years in the UK, significant increases in corporate leverage, in household leverage, but also, interestingly, in financial sector leverage, which is the scale of the financial sector lending money to itself. On the longer time series on the US, look at that extraordinary impact of the deleveraging after 1929, and then the huge leveraging up of the economy, not just over 30 years, but over a 60-year period. We now have, compared with the 1950s or 60s or 40s, a massively more leveraged economy with massively large financial and, in particular, banking sectors. Because what we have seen is that process of simultaneous bank credit and money creation. You can see here, for the last 50 years in the UK, household credit as a percent of GDP has gone from 15 to 80% of GDP. That's a transformation in the scale of credit. And you can see on the red line here, the somewhat matching increase in deposits, because broadly speaking, in a total closed economy, the credit is balanced by the deposits. It isn't in this picture because of the ability of the UK to run current account deficits and borrow wholesale money from overseas. What we also saw, and again, these are the figures from the UK economy, is major changes in where credit was going. The orange area on the top there is the increase in commercial real estate lending. No further increase, you'll notice, in the UK or in the US in non-commercial real estate, PNFC lending, so lending to non-commercial real estate companies not going up as a percent of GDP, but dramatic increases in the real estate. So we have sat through very significant increases in the scale of the banking system, in the amount of leverage in the real economy, the balance between debt contracts and equity contracts, and with an increasing percentage of debt supporting a real asset which is capable of entering an asset and credit cycle such as Minsky described. And finally, I won't show the chart on this, in addition to that occurring within the banking sector, we saw the development before the crisis of a shadow banking sector, which is essentially a mechanism of creating outside formal bank regulation the precise economic equivalent of bank credit and quasi-money creation. So we had, I'm suggesting, 4 pre-crisis delusions, and those delusions led us to be largely indifferent and blind to very major changes in the leverage in our economy and the financial risks within our economy. And in particular, they made us blind on the 4th line there to the growth of credit as a percent of GDP. We developed a thesis, in some cases, that we needed credit growth to grow faster than GDP to maintain adequate demand, or certainly that if it kept on growing faster than GDP, there was nothing wrong with that there was no limit, that we didn't have to pay attention to the stock figures of debt to GDP. I think that is a major mistake, and I think a lot of good economic research is now beginning to challenge that. If you look at the work of Alan Taylor and Moritz Schullerich, who are recipients actually of INET grants, they have been looking at the increase of credit, which is therefore an increase in financial intensity, financial deepening you might call it, and concluded that that financial deepening, at least in the developed economies over the last 30, 40 years, has at very least not provided any beneficial impact on growth. But more seriously, I think we are beginning to see the emergence of hypotheses, for instance, suggested by this work, which comes out of the BIS, a study by Steve Cicchetti and Anis Karoubi, which are suggesting that if you look at the relationship between credit and GDP, there may be an inverse U function, that up to a certain point, financial deepening, the creation of a banking system, the provision of credit, is positive for growth, but you can reach levels of credit to GDP which are negative. Now, what is interesting is that wouldn't at all have surprised those mid-20th century economists, because they believed, as it says here, Henry Simons in his famous article, Rules versus Authority, that in the very nature of the system, banks will flood the economy with money substitute during booms and precipitate futile effects at general liquidation afterwards. They believed that private initiative has been allowed too much freedom in determining the character of our financial structure and in directing changes in the quantity of money and money substitutes. Now, in that phrase, Simons is focusing on the money side of the bank balance sheet, but always remember the money side of the bank balance sheet is just the flip side of the credit side of the bank balance sheet. So from both points of view, the hypothesis is that you can create too much credit and too much private money. Why did Simons and Fisher, in particular, writing in the 30s, believe that? Well, of course, they believed it because they were the inheritors of the crash of '29. And they were trying to understand what had gone wrong in that huge creation of credit as a percent of GDP in the 1920s. And they ended up, as a result, ending up with a very radical position. They believed that it was so clear that credit could be created to excess and money created to excess that they ended up believing that we shouldn't have fractional reserve banks at all. They wanted 100% reserve banking. So every deposit would be backed by a central bank reserve. The monetary base would be the money supply. The only money would be, in Gurley and Shaw's terms, outside money. There would be no inside money created privately by the financial system. Now, I think they were too radical. I think there is an argument for fractional reserve banks up to a point. I think there are reasonable arguments put forward, for instance, by Walter Bagehot in Lombard Street, that the existence of fractional reserve banks performing a maturity transformation function may facilitate the mobilization of savings and investments which might otherwise not occur. I think it is also the case that fractional reserve banks facilitate welfare-enhancing smoothing of consumption across the cycle, and I think that that can be a welfare-optimal function, even if it has no positive effects on growth. I therefore think that actually abolishing fractional reserve banks, as has been proposed recently by a number of people, Michael Kumhoff, for instance, Larry Kotlikoff, in the last few years, I think it's too radical. But I do think that when you think about the arguments, I think when you think about the fundamental nature of the risks that debt creates, although I wouldn't go as far as fractional reserve banks, I think that these arguments provide a good argument for us dramatically increasing the fraction of liquid reserves and the fraction of capital resources. Because once you've thought about those arguments about what private money and credit is and what debt contracts do, I think you realize that the regulation of the amount of private money creation and of private credit creation is a crucial function, and that through our capital and liquidity a regulation, we are essentially controlling the amount of that credit and money creation. And that is why, from a macro point of view, not just from a micro corporate finance point of view, but from a macro point of view, I am certainly attracted to the idea that if one were a benevolent dictator of a greenfield economy, which of course is what everybody in this room dreams of being, and unconstrained by transition problems, one would set capital ratios at banks not at the sort of 7% risk-weighted ratios to which we've managed to creep them up in the Basel III reforms, but more at 25 or 30% or something like that. I think we are the inheritors. I have felt for the last 4.5 years as a financial regulator as the inheritor of a 50 to 100-year mistake in which we have allowed the banking system to run with far too low fractions of capital and liquid assets. And I further believe that we have got to identify the total level of debt within our economy, that overall balance between debt and equity contracts, as a crucial determinant of instability, and therefore, if necessary, focus on it, not only through the mechanisms of banking regulation, but also through the direct regulation of the amount of loans out there in the economy. For instance, through loan-to-value ratio or loan-to-income ratio limits. Now, of course, or other constraints on the total amount of credit extended against real assets. Now, of course, that doesn't always make you popular. Norman Chan was just telling me over drinks that his latest operations to slow down the Hong Kong property market have made him a bit of a hate figure among the 30,000 real estate agents here in Hong Kong. But I think we do increasingly have to treat the total amount of debt as a crucial variable. And that therefore suggests the first great insight of those early laissez-faire writers. Finance is different, debt is different, banking is even more different, and the arguments for laissez-faire, which are strong in some other sectors of the economy, are simply not applicable. But the second thing which those mid-20th century laissez-faire economists believed was that monetary and financial stability are very closely interlinked concepts. And that, I think, was the other thing that we missed in the pre-crisis period. The implication of what I've said before, or one implication, is that we mustn't let leverage get to excess levels. The best thing is not to allow leverage to get to an excess level in the first place. And that's because it tends to produce a crisis, and because when you go through the crisis, you then enter an immensely difficult macroeconomic phase of private sector deleveraging and potential deflation. But once you're in that position, you've got to deal with that position. And you've got to have macroeconomic policies to deal with that position. Once you go through a crisis, which follows many years of lending growth above GDP, when by definition debt to GDP as a stock ratio is going to go up. And you can see that over many years where lending to UK businesses is running well ahead of nominal GDP rates. When you have a financial crisis and you enter this phase, you then end up with very low credit growth. Now, that is partly because your financial system is impaired and credit supply is impaired, but it is also because the credit demand simply isn't there. And I think one person who has described better than anybody else why that occurred is Richard Koo, who's seated over there, within his concept of understanding what has happened in Japan as a balance sheet recession. When you end up with too much credit, debt to GDP, too high levels of leverage, and you go through a crisis, you enter a period in which either corporates or households, it depends on which sector of your economy is over-leveraged, are determined to get their balance sheets back into balance, and who therefore become pretty much totally inelastic to anything that you can do with the interest rate. So that if you look at Japan, you see in the red line the reduction in the policy rate in the early to mid-1990s effectively to zero, but you see credit growth essentially negative or zero as well. Because what is going on in that environment, again in the red line here, is that the private non-financial corporations, the corporations in Japan, are running a continual financial surplus to get their balance sheets back in balance, and they are imposing a deflationary, deleveraging effect on the economy. In that environment, as Richard, I think, has persuasively argued, the government has to run a large fiscal deficit, which you can see in the blue line there, because without that, you have a deficiency of nominal demand. But the problem with them running that deficit is the stock effect. The stock effect in the blue line there is general government debt to GDP in Japan going up from 60% in 1990 to over 200% today. Because what you enter is an environment where the private sector attempt to delever works in the private sector, but it simply shifts leverage to the public sector of the economy. So that for every percentage point you see on the red line there, the corporate sector, there is 2 or 3 percentage points increase in the fiscal deficit, in the fiscal debt to GDP. That's the pattern we've seen in Japan for the last 20 years, and it is the post-crisis pattern in the UK, the US, and Spain. In each of those, I hope you can see, what you have is the private sector attempting to and beginning to achieve a small amount of deleveraging, but you have a shift of that leverage over to the public sector of the economy. This creates a major problem, a major danger of deflation, as indeed in the 1930s. And you therefore have a major issue for macro policy. In this environment, how do you maintain adequate nominal demand and therefore a reasonable combination of real output growth and price stability as defined in the way that I think it ought to be defined as low but positive inflation rates? On that issue, should we here consider also the radicalism of Simons, Fisher, and Friedman in '48? Because what they said was fund fiscal deficits with money finance. Well, to think clearly about that issue, I think we need a framework of how the levers of macro policy relate to the effects. And I'd like to suggest this framework, which I suggest is important to think straight on this issue. At the middle of the framework, in the red box, is aggregate nominal demand, which is nominal GDP. That is really the fulcrum of macroeconomics. What determines and what are the implications of the rate of growth of nominal GDP? On the right-hand side, you have the simple mathematics that an increase in nominal GDP can either be an increase in prices or an increase in real output, and therefore also that is true in total, and it's also true at the marginal level. When you increase nominal GDP, you might increase the price level or you might increase real output. So those are the effects. On the levers side, there are a set of different policies which might influence nominal GDP. Those include fiscal policy, deficits and surpluses, monetary policy, interest rates, QE, forward guidance, central bank private credit support, such as US credit easing or the UK's funding for lending scheme, and also macroprudential policy, the level which the regulators set in terms of the capital or the liquidity requirements of banks. Now, those are the classic levers, and what I want to discuss, among other things, is one extra lever, which I'm going to call OPMF, which stands for Overt Permanent Money Finance. Overt Permanent Money Finance, sometimes later I call it Overt Money Finance, OMF, but it has to be permanent to be effective, is essentially a combination of the fiscal and monetary levers. It's running a fiscal deficit which you finance with central bank money. So that's my framework, effects and levers. And I'd like to make 2 points about that framework. The first, I want to assert something which I call the independence hypothesis, which I think is important. And that is that I want to assert that the division of any increase in aggregate nominal demand between prices and real output is not determined by the lever that you pulled, but by a set of real economic characteristics, such as the level of spare capacity in the economy, in capital or physical capital, or the flexibility of price-setting processes in labor or product markets. That basically, if there is spare capacity, and if there are flexible price-setting processes, a large amount of that aggregate nominal demand will go into real output. But if you are at full capacity utilization, or if you have inflexible price-setting processes, a large amount might go into prices. But that broadly speaking, the division of the aggregate nominal demand increase between prices and real output is independent of the lever, the tools that you've pulled to affect aggregate nominal demand. Now, the reason that is important is that a lot of debates about what we do in the present deflationary period are bedeviled by random, non-independence assumptions which are not well specified. You get people who simultaneously say, you can't run a fiscal deficit and print money because it'll be inflationary, but who say, we've got to reduce the capital requirements on banks in order to extend credit to the economy, because that will get the economy going. Now, what they're assuming there is that they've got one mechanism of increasing aggregate nominal demand, which is necessarily going to have a price effect, and that another is necessarily going to have a real output effect. But my assertion is it's not the lever that determines that, it's those real factors on the right-hand side. That's my first assertion about this framework. My second is that the one problem in economics to which there isn't always a solution is inadequate aggregate nominal demand. I don't think there are any other problems in economics to which there are always solutions. But what I mean by that is if we face absolute deflation, which is both falling output and falling prices, so we definitively know it would be good to have more aggregate nominal demand, there is always a solution. And that if we fail to take that solution, we should really be condemned for having failed to be imaginative enough, but not all that imaginative, because it simply requires doing what Milton Friedman and John Maynard Keynes both said we should do. Milton Friedman said, spread helicopter money about. John Maynard Keynes said, put pound notes in bottles in disused coal mines. Bit odd, that relationship, because Keynes was not normally the Puritan who demanded that you work for your efforts. He was a believer in the good life, but essentially the same proposition. At the limit, we can always increase aggregate nominal demand. Let me make one final point on this framework. I suggested an independence hypothesis, but I also recognize that you can challenge that independent hypothesis. You could suggest that there are links which directly link something on the left to something on the right. For instance, if it is believed wrongly or rightly by the market that either fiscal policy or monetary policy or overt permanent monetary finance will tend to have an inflationary effect, we have to be somewhat alive to the danger that that in itself might become self-fulfilling. So it is possible to define an expectational channel where that particular form of stimulus does have more of a price and less an output effect. It might also be possible to convince ourselves that we're clever enough to define some left-hand side levers which would simultaneously increase aggregate nominal demand and the capacity of the economy, for instance, by infrastructure or capacity investment, in which case you might say you can do something which would skew the result to real output. But the crucial thing that I do argue is that whatever non-independence hypothesis you're making, you must specify what it is. And you mustn't simply leap to your favorite policy response by assuming that it will tend to have more of a price or more of a real output effect without specifying why you are breaking away from independence. So that's my framework. Let me, as quickly as possible, now talk about the different ways that we could stimulate aggregate nominal demand. We could do it through the three boxes shaded darker on the right-hand side, through a combination of things in the monetary policy, central bank credit support, and macroprudential space. And broadly speaking, this is the policy being pursued in the UK and the US at the moment. We are doing things like standard quantitative easing, buying government bonds, wider quantitative easing, buying private bonds, equity, property, FX in Japan at the moment, liquidity support in the European environment through LTROs, direct credit subsidy in the UK through funding for lending, macroprudential policy, some degree of forbearance in terms of the pace at which we would otherwise increase capital or liquidity standards to acceptable levels. That is certainly the UK policy mix at the moment, fiscal austerity supposedly offset by this combination of monetary and macroprudential levers. And let me make it plain that several of these levers I have directly supported in my own role within the UK policy environment. And if I had in addition been on the Monetary Policy Committee, I would have also argued for the level of QE which we have in the UK. So I'm not against these levers. But I do believe that we have to be aware that these levers may be subject both to diminishing marginal effectiveness and to adverse side effects. Why might they be subject to potential limitations? Well, it's crucially important to realize that these levers work through indirect channels. They essentially stimulate credit growth, or seek to. They seek to stimulate asset price increases and a search for yield. And it is possible that those are limited, first of all, if borrowers are, as Richard Koo has suggested, totally focused on strengthening balance sheets, then the extension of QE to the longer end of the yield curve may bring down long-term rates as well as the policy rates, but you may still not get a credit demand response. Long as well as short-term interest rates may approach the ZLB. As for adverse side effects, this policy commits us to low interest rates over many years, or in Japan, decades. It is essentially trying to work through a stimulus to private leverage. And that's a slightly odd thing to do. This is the hangover cure, which is another drink, the hair of the dog that bit you. Relaxed prudential standards are bound to produce future financial stability risks. Exchange rate spillover effects might be significant, and there are also distributional effects. These policies tend to be very good for asset owners at the top end of the wealth and income distribution and less good for other people. So I am concerned that this policy mix of relying entirely on monetary and macroprudential levers is subject both to diminishing marginal returns and to adverse side effects. So the alternative, the classic alternative, is funded fiscal stimulus. You run a budget deficit. If it isn't sufficient, you run a larger budget deficit. And the great benefit of that, of course, is you're either cutting someone's taxes, you're increasing expenditure, you're putting money directly in someone's pocket. As Milton Friedman said in his 1948 article, you're doing something which directly goes into the income stream. You're not working through these complicated portfolio balance, asset balance effects. You're directly impacting the income stream. But the argument against those mechanisms, funded fiscal stimulus, has always been twofold. First of all, that you will induce a crowding out effect, whereby you simply increase interest rates because you are borrowing more money to fund those fiscal deficits, or you will produce a Ricardian equivalence effect because the person who is getting the benefit of that tax cuts knows that they'll have to pay for it in 10 or 15 years' time by servicing the debt which has been piled up. Now, in relation to the first of those, the crowding out effect, I think Brad DeLong and Larry Summers, in a recent important article, have put forward a very powerful counterpoint of view. And they've argued that when interest rates are constrained by the zero lower bound, discretionary fiscal policy can be highly efficacious as a stabilization tool. Indeed, under plausible assumptions, it could actually improve long-term debt sustainability. And the core of their argument is that the fiscal multiplier which is low in normal times because the bigger the debt you run, the higher the central bank will put the policy interest rate, that's not true in the current times that we face, because the central bank is committed to keeping interest rates at the ZLB, the zero lower bound, for the foreseeable future. So they basically say, if you've already got a Ben Bernanke who said, I'm keeping interest rates low to 2015, the crowding out effect of higher fiscal deficits simply is not there. And I think that is fairly compelling. But it still leaves the Ricardian equivalence effect. It still leaves the problem of what are you going to do if, with large fiscal deficits, you have a relentless increase in debt to GDP, such as we have had in Japan. The headline level, the top level, the red line, going over 200% of GDP, over 150% of GDP, even when you take out the holdings of the Bank of Japan, over 100%, even when you take out the holdings of Japan Post, and 100%, even if you take out the holdings of the commercial banks. What do you do about the fact that funded fiscal stimulus can produce a relentless rise in government debt? And I'm going to do something I never normally do in a speech. I'm going to make a prediction, a market prediction. Japanese government debt is not going to be repaid in the normal sense of the word repaid. If we mean by repaid that Japan, having run large fiscal deficits, is at some stage going to run surpluses sufficient to pay down this debt, forget it, it is not going to occur. This debt is either going to be monetized or restructured at some stage. It's going to be offset by a high level of inflation, which essentially means that people will have bought this debt at a negative real interest rate. It will not be repaid in the normal sense of the word. So what do you do if you're in that situation? Well, what Ben Bernanke said in 2003 was that you do a money finance tax cut. He argued quite overtly then for a tax cut for households and businesses that is explicitly coupled with incremental BOJ purchases of government debt so that the tax cut is effectively financed by money creation. He said it was important to be clear that much or all of the increase in the money stock arising from that is viewed as permanent. He said the good news is consumers and businesses will spend that tax cut since it is a tax cut which creates no current or future debt servicing burden. Don't worry about Ricardian equivalence, even if they were the sort of consumers who wander around each day of the week worrying about Ricardian equivalence. And he said the debt to GDP ratio will fall because there is no increase in nominal debt, but nominal GDP would rise owing to increased nominal spending. And he said, I'm proposing this for a tax cut, but you could use exactly the same argument to support increased spending programs to facilitate industrial restructuring. That's what Ben Bernanke argued in 2003. He argued that you should do it in special circumstances. Interestingly, Henry Simons and Milton Friedman argued that you should do it as a perfectly normal procedure in all times. Milton Friedman on the right, under the proposal, government expenditures would be financed entirely by tax revenues or the creation of money. That is the issue of non-interest-bearing securities. Money is simply a non-interest-bearing government security. The chief function of the monetary authority would be the creation of money to meet government deficits and the retirement of money when the government has a surplus. And Henry Simons argued exactly the same. Now, there's an important wrinkle here. It was much easier for them to argue that, having already argued for 100% reserve banking, because they've created an environment in which the monetary base is the money supply. But even when we're not in that world, even when we have fractional reserve banks, I think there is still an argument under some circumstances for overt money finance. I think its advantage over monetary credit support and macro stimulus is it works directly rather than by a set of indirect levers. And I think its advantage versus funded fiscal stimulus is that it clearly is not subject either to crowding out or Ricardian equivalence effects. But isn't it inflationary? Isn't money finance of public deficits inflationary? Well, if you go back to my independence hypothesis, no, if you're in an environment where you want to stimulate aggregate nominal demand. And if you don't want to stimulate aggregate nominal demand, you shouldn't be talking about all these other mechanisms by which we might stimulate aggregate nominal demand. Your prior first step is to work out, do you want to stimulate aggregate nominal demand? And if you do, we should then look at all the levers available. So why are we so terrified of money finance of fiscal deficits? Well, there's a very, very good reason. Technically, overt money finance of fiscal deficits is no more inflationary than any other way that we stimulate nominal demand. And like all other ways, its impact on inflation will depend upon the amount that you do. If you do $1 billion, you'll have a very small amount. If you do 10 trillion, you'll produce hyperinflation. It's simply a spectrum like most things in economics. But the argument against it is that it isn't a spectrum because you've let the cat out of the bag, because you've broken a taboo. The argument against overt money finance, and again, Friedman said it in 48, is that this proposal has, of course, dangers. Explicit control of the quantity of money by the government and the explicit creation of money to support actual government expenditures may establish a climate favorable to irresponsible government action and to inflation. The difficulty here is not a technical problem, it's a political economy problem. It's once having admitted and revealed to the populace and politicians that this is technically possible, how do we make sure that we do it in the small number of years out of each century where I would argue it's appropriate, and in the quantity that is appropriate, rather than all the time and in inappropriate amounts? OMF carries political economy risks. That is why overt money finance has in central banking and in economics a close to taboo status. And taboos, I think we were probably quite close to this in that session in mimetic sacred systems this afternoon. Taboos have valuable roles within human society. But sometimes, if you've got a powerful potential mechanism, you should have the confidence to take it out of the taboo box. And I believe it is capable for us to use it and to use it in responsible amounts. And I think it is possible to locate it within the same disciplines of central bank independence in pursuit either of inflation targets or of nominal GDP targets with which we have constrained the use of all policy levers. But it is because it's a taboo subject that even when highly respected economists propose it, they don't actually call it that. So I think of overt money finance as a sort of policy that dare not speak its name. If you look at the highly erudite speech which Michael Woodford, one of the great canons of New Keynesian monetary economics, gave at Jackson Hole last August, he talked about the fact that optimal policy now requires policy action that would stimulate spending immediately without relying too much on expectational or indirect channels. He said the most obvious source of a boost to aggregate demand, which would not depend on expectational channels, is an increased fiscal stimulus. And then he said, you need to be clear that having funded that with money, which is what he described, the increase in the base money is intended to be permanent. Now put that together, and that's pretty much what Ben Bernanke said, that is overt money finance. But he doesn't quite call it that because we have a taboo against it. I think we need to be able to break the taboo. I think the taboo just did get broken in Japan earlier today by the interventions of Mr. Kuruda. So I want to end with two thoughts. What am I really saying by four major economic currency zones? One, for Japan, Bernanke was right. Japan has been absolutely right, as Richard Koo has suggested, to run large fiscal deficits, but those fiscal deficits will not be serviced in the normal sense of the deficit turning into a surplus. They need to be monetized. If they had started monetization 10 years ago, Japan would have been in a better state today. It has left it so late that there are some dangers, that there's so much debt out there that the process of monetizing it could get out of control. But Bernanke was certainly right in 2003. In the US, you could argue that the policy mix is damn close to overt money finance. Ben Bernanke keeps on signaling to the fiscal authority that they should be happy to run large fiscal deficits and making it plain that he will monetize them if necessary, in which case, why scare the horses by telling them what's going on if we're roughly doing the right stuff in any case? In the Eurozone, optimal policy is blocked by incomplete currency union. It's damn difficult to agree to monetize financial debt when monetizing it in the Eurozone would be like the Fed buying state of California debt or state of Illinois debt, not federal debt. Because that's what Spanish debt and Italian debt are. They're the functional equivalent of state of California and state of Illinois. So a whole load of distributional and discipline issues get in the way of optimal policy. In the UK, actually that's the area where I'm least convinced that we're absolutely certain we need more nominal demand, because the odd thing about the UK for the last 4 years is that 80% of all our increase in nominal GDP has gone into a price effect rather than a real output effect. So I'm a little bit wary in the UK of simply believing we need more nominal demand. But to finish, although I'm setting out those 4 possibilities of policy there, actually my main purpose tonight is not to suggest these specific policies, but to draw these lessons from those earlier writers. First, financial stability and monetary policy issues are closely linked in a way which we dangerously ignored before the crisis. Secondly, we need to understand that debt contracts are different, banks are different, credit and asset price cycles are different, and therefore the level of leverage within the economy, the pace of growth of leverage, these are crucial macroeconomic variables. The economy, the monetary system is not neutral to the financial system, and we have got to have specific policies to focus on it and to contain the level of leverage. And thirdly, if you don't do that in advance, you end up with excess levels of leverage which produce financial crisis, and that financial crisis tips you into extremely difficult deflationary and deleveraging period in which you have got to be innovative and creative and open-minded about the policy levers available to pull you out of that situation. So that is my hypothesis, and I now look forward to hearing the various ways in which Bill White and Hiroshi Watanabe are going to disagree with me. Thank you very much indeed.